Welcome to my revision course on financial reporting. My name is Senior Hannington, and it's my privilege to help you to get through the May exam. Today we are looking at consolidations, and the first question I thought I would do is from the November 2023 exam paper. So download the November 2023 exam paper from the iSpower website. Then you move straight to question 4. That question paper should be on your table such that we move together step by step. So I'm on question 4 of the question paper. That is, this question is about consolidation. So you'll have a read of the question. One big idea is to start with the requirements of the question. So go to the requirements of the question and read the requirements and see what you're supposed to do. In accordance with IFRS 10, consolidated financial statements, and IFRS 3 business combinations, prepare a consolidated statement of profit and loss and other comprehensive income for the year ended 31st January 2023 for Datam Enterprises Limited and Group, taking into considerations all the additional information. So that's the information we have. We have been told that Datam is a company that provides internet services in Uganda. In order to expand its operations, Dell, that is Datam Enterprise Limited, acquired 70% of the equity shares of SIM Technologies Limited STL on 1st February 2022. So here we see the parent, which is Dell, then the subsidiary, which is STL. We'll go to my workings page. The first thing I can draft very fast is the group structure. So this is my workings page. Just a simple group structure. We have to see who the parent is. The parent is Dell. This Dell acquires STL. We have seen that the acquisition date, this is on 1st Feb 2022. And of course, when you try to look at the requirement, when you try to look at the question, the statements of profit and loss and other comprehensive income given are for the end of 31st January 2023, meaning that the post-acquisition period. So we have 1 year post-acquisition period. That is the period from the date of acquisition to the reporting date. We have the percentage acquired. Dell acquired 70% of STL's equity shares. Therefore, our NCI is 30%. That is the NCI in this case. We don't have the cost of the acquisition. We don't have the fair value of the identifiable net assets at the date of acquisition. So we cannot compute goodwill in this case. And of course, when you try to look at the requirements of the question, unless there is impairment loss somewhere, the working for goodwill is not needed in this case. So that is my group structure. I'll take you to the additional information because I'll come up with the different workings based on what we have in the additional information. So the first note, during the end of 31st January 2023, smartphones which had cost STL sharing 72 million were sold to Dell. As of 31st January 2023, 62.5% of the smartphones were still in inventory of Dell. It is the policy of STL to charge markup of 20% on cost when determining the price to charge its customers. Now, this is an intra-group trading. So we have to find out the sales revenue, which sales revenue has to be eliminated. on consolidation, as well as the intra-group purchases. These have to be eliminated from the consolidated statement of profit or loss. The consolidated figure for sales revenue and the cost of sales should always represent the sales to and the purchases from the outsiders. Therefore, an adjustment is necessary to reduce the sales revenue and the cost of sales figure by the value of the intragroup sales during the year. But in this case, we don't see that value being given like in the other questions, because the examiners normally give you the sales value of the goods that were sold. But in this case, we have been given the cost, which is 72 million. But of course, they are also giving us the pricing policy for STL. So when we use the pricing policy, then we can arrive at the sales revenue of these smartphones. So my working tool is about the intragroup trading. It's about the intragroup trading. So our intragroup sales and purchases will equal to the cost. This cost is 72 million. That's according to the information given, note 1. We have a 72 millions. But of course, they add a markup of 20%. Markup is profit percentage on the cost. Markup is profit percentage on the cost. So this gives us how much? 72 millions times, that gives you 86 millions 400,000. It gives us 86 millions 400,000. That is the revenue which you come up with in this case. 86 millions 400,000. 86.4 M. 86.4 M. Now this has to be cancelled out. This has to be cancelled out. So I will say cancel the intra group sales and purchases. How would we do the cancellation? So we debit group revenue, that is by 86.4 M. Then you also credit the cost of sales of the group by 86.4 M. That is your adjustment to make on the revenue and the cost of sales of the group. You have to cancel out the intra-group trading. That is the sale and the purchase. So you have to cancel out that. Then maybe the other thing which you need to know is that we have to calculate what we call the provision for unrealized profits, the PUP. The PUP. So this is 86.4 times 20 over 120. Then times the percentage of the goods that remained unsold. That is 62.5% of the goods remain unsold. 62.5%. So here we are trying to come up with a provision for unrealized profit, because there are some goods that remain in inventory of the group. So we have to find out the unrealized profit. we have to find out the unrealized profit. And the unrealized profit is 9 millions. Why do I compute this? Remember, whenever goods sold at a profit within the group remain in the inventory of the purchasing company. In this case, the purchasing company is Dell, the parent. Any unrealized profit should always be excluded from the figures of the group profits. So the best way to deal with this is to calculate the unrealized profit on the unsold inventory, which is this at their end, and then reduce the consolidated profit by this amount. So what you do, we say that cancel out shillings 9 millions by what? So we shall debit the cost of sales by 9M. Then we have to credit the group inventories by 9 million. So when I'm consolidating, I have to make these adjustments when coming up with a consolidated statement of profit or loss and other comprehensive income. I'll take you to note 2. On the acquisition date, DEL, the parent, sold a motor vehicle with a carrying amount of shilling 32 million and the estimated remaining useful life of 10 years to STL at shillings 43 million. Dell and STL depreciates motor vehicles over their useful life using the straight line method of depreciation with 0 scrap value. So this is my second working. This is note 2, but this note 2 is going to guide me on how I can make working 2. So working 2 is can call this intra-group sale of non-current assets. Intra-group sale of non-current assets. Now, when it comes to such a transaction, the selling company, of course, will record a profit or loss. The selling company will record a profit or loss on sale, while the purchasing company will record the asset at the amount paid to acquire it. It will use that amount as the basis for calculating depreciation. In this case, Dell is the seller, then STL is the purchaser. Of course, on consolidation, the usual group entity principle still applies. The consolidated statement of profit or loss must show the depreciation charged based on cost of the asset. The adjustment needed to achieve this is to remove any element of unrealized profit or loss. And the depreciation charged must be based on the asset's cost to the group. Let us try to see. We have a carrying amount of this vehicle given as shillings 32 millions, if I'm not mistaken. Yes, it's shilling 32 millions. Then the disposal proceeds, we have 43 millions. Those are the disposal proceeds. Disposal proceeds we have 43 millions. So here we have a profit on transfer of how much? 11. We have a profit on transfer of 11 millions. That profit has to be eliminated, okay? That has to be eliminated from group accounts because the asset is still with the purchaser. So there is no any profit that was realized when it comes to this motor vehicle that was transferred. Then maybe the other thing is to find out the depreciation, because the depreciation should be based on the carrying amount of 32 millions, not the 43 millions. So we have that extra depreciation, i.e. that is the depreciation of the profit. Divide by 10 years, and that depreciation is how much? That depreciation is 1.1, I think. 11,000 divided by 10, that is 1.1. That is 1.1. Yeah, that is 1.1. That is the depreciation. So the required adjustment, first of all, the profit on transfer should be eliminated. This should be eliminated. So what you'll do, you'll debit what? Should we assume that this profit was recognized under other incomes? Okay, let me assume that the profit was recognized under other income. So I'll say debit other incomes. That is by shillings 11 millions. There I'm cancelling out that profit. Then I'll go and credit the group PPE. That is statement of financial position, though in this case it's a P&L question. So that is the profit on transfer. Then I'll also eliminate the extra depreciation charged against profits of STL. And to do that, I'll debit other operating expenses. That is on assumption that the depreciation expenses charged to other operating expenses, debit other operating expenses by the depreciation, the excess depreciation of 1.1. Then I'll credit. No, this should be, sorry. So I'll debit the group PPE. That is in the statement of financial position by the extra depreciation. So I'll add it back. Then I'll credit other operating expenses. The assumption is that depreciation was charged under the other operating expense. That's the assumption I'm trying to make here. Okay, that depreciation was charged. Depreciation was what? Depreciation was charged under the other operating expense. So that is the adjustment I'll make when it comes to the intra group sale of or transfer of a non-current asset. I'll show you how to incorporate that in your consolidated statement of profit and loss. So from there, I'll move to the third note. Effective 1st February 2022, Dell started providing management consultancy services to STL at a monthly fee of shillings 1 million. STL recognizes this amount as an operating expense. Still, this is an intra-group trading. One company is providing a service to the other. So this is my working note 3. Can call this management consultancy services. Management consultancy services. I can simply say that Dell recognizes shillings how much. Remember, this is a monthly fee of 1 million for a period of 12 months, so that is 12 millions. Dell recognizes shillings 12 millions. As other incomes, and set STL recognizes this as operating expense. As operating expense. So what happens on consolidation? On consolidation, shillings 12 millions should be cancelled out. Should be cancelled out, i.e. I'll debit other incomes of the group by shillings 12 millions, then I'll credit other, we'll call it operating expenses, as stated in the question. Credit operating expenses. By shillings 12 millions. Credit operating expenses by shillings 12 millions. These are intra-group transactions, okay? So the incomes and the expenses, the incomes should be from outsiders, okay? Should be from services provided to outsiders. Then the expenses should be incurred to provide services from the outsiders. So since the 12 million is intra subsidiary to parent, then we have to eliminate that when it comes to the consolidated statement of profit and loss and other comprehensive income. Note 4, let's look at note 4. On acquisition date, all the assets and liabilities of STL were reflected at fair value, but the buildings with the remaining useful life of 5 years had a value of 5 million higher than the fair value. This time round, this is the fair value adjustment, but now we see that the building was overstated. Its fair value was overstated. So you have to make the necessary adjustment. So this is my working for, I think. Is it working for? Yeah, this will be my working note for. The fair value adjustment. The fair value adjustment. Remember, at acquisition, the net assets should always be fair valued. but in this case there was an overcharging, there was an overstatement of the value of the buildings. So meaning that the financial statements of the parent, of the subsidiary rather, the assets were overstated, and even the depreciation charged was overstated. So we have to find out the adjustment to make in the consolidated statement of profit and loss. So the building had a value of 5 million higher. So we say 5 million higher. Useful life is 5 years, so you have to get the movement. The movement is how much? What is 5 millions? Divide by 5 years. That is 1 million. So meaning that by the year end, we have a 4 million. We have a 4 million in the statement of financial position of the subsidiary. So the adjustment you're going to make in this case, you have to reduce so the required adjustment, you will have to debit. You'll have to debit what? You'll have to debit the asset was overstated. The asset was overstated. Therefore, there is an overestimate of the assets in the statement of profit and in the statement of financial position. So since we are looking at the statement of profit and or loss, so for you what you have to do, you have to reduce. So required adjustment, adjust the operating expenses, i.e. credit the operating expenses with the shillings 1 million. Okay, of course, now the corresponding debits, one thing you need to know is that the goodwill figure will be affected by this fair value adjustment, as well as your non-current assets in the statement of financial position. But in this case, what we are looking at is the statement of profit and loss. So you have to just go and reduce the operating expenses by 1 million on assumption that depreciation expense is charged to the operating expenses. So being that the building's fair value was overstated, even the depreciation was also overstated, so you have to just reduce it by shillings 1 millions. Then according to note 5, this is note 5, during the end of 31st Jan 2023, Dell and STL paid dividends of shillings 30 millions and 15 millions respectively. Details of other incomes for the year were as follows. Income from management consultancy, we have already seen that. Profit on sale of motor vehicles, yes. Then you also have dividends received. I think I need to come up with something about the dividends, the intra-group dividends. That is note 5. The intra-group dividends. So one thing you need to know about the intra-group dividends is that the dividends paid by the subsidiary, paid by STL, in brackets sub, To the parent are cancelled. Are cancelled on consolidation. Are cancelled on consolidation. I.e., that is 70% of the dividends paid by the subsidiary. The subsidiary paid details of other incomes for the subsidiary paid 13 millions. Are they 13? Sorry, the subsidiary paid 15 millions, yes. Paid dividends on 30, that is parent, and then 15 millions. Okay, so 70% of those dividends were paid to the parent. So 70% of 15 millions, that is how much? 0.7 times 15, that is 10,500,000. 10,500,000. 10,500,000. Yeah. Are cancelled on consolidation, i.e., the 10,500 should be eliminated when consolidating. So this is what we have. These are some of the workings. So now I think we can go and start on the consolidated statement of profit and loss. I have my workings already. So when it comes to the consolidated statement of profit and loss, this is Dell Group consolidated statement of profit or loss and other comprehensive income for the year ended when? For the year ended the 31st Jan 2023. So that is my heading. Now I can start consolidating. Remember, the source of the consolidated statement of profit or loss is the individual statements of profit or loss of the separate companies in the group, that is DEL and STL. So use workings to show the calculations of the complex figures such as the NCI, and of course you will show the derivations of others on the face of the statement of profit or loss, as I'm going to show you. Of course, remember, in the consolidated statement of profit and loss, NCI is brought in as a one-line adjustment at the end of the statement of profit or loss. So we are going to start consolidating. The acquisition was made at the start, so there is no time apportioning. I'll consolidate 100% revenue and 100% revenue of the parent and subsidiary. Okay, so I bring all the figures 100%, no time apportioning in this case. So we start with the revenue. You have to get the revenue of the parent, which is 946,000 plus, that is the revenue of the parent and the subsidiary, but there is an intra-group trading. We said we have to eliminate something. We have to eliminate the intra-group purchase and sale. That was 86.4, I think. 86.4. and we say that we have to debit the group revenue and then credit the group cost of sales. So minus 86.4, that is from your working one. So when you do that, 94,600, 6,000 plus 474,000 minus 86.4, this gives us revenue for the group as 133,600. That is your revenue. Then you move to the cost of sales. Parent is 378,400 plus the subsidiary with a 209,600, but I have to less the intra group purchase of 86,400. Then there is also something to look at, that is the PAP, the provision on the unrealized profit. We say that we debit cost of sales by 9 millions. So I'll add 9 millions. Debiting cost of sales, that is increase in the cost of sales. I'll add 9 millions, still from working one to the cost of sales. So 378,400 plus 209,600 minus 86,400,000 plus 9 millions. That gives me 510,600. So you'll get your gross profit. You get your gross profit as 823,000. Of course, the next item, they show the other incomes. Parent, other incomes. The parent is how much? That is 36,000. Other incomes, 36,000. But I've told you there is an intra-group dividend which you have to minus. That is 10,500. The intra-group, that is from working 5. So minus 10, that is working 5. Then management consultancy services, there is something to minus. Other incomes, debit 12 millions, other incomes, so minus 12 millions. That comes from my working 3. Yep, it's working 3. Then there is also the profit on the sale of the non-current asset. I think we talked about that. And I told you that debit other incomes by 11 millions to eliminate that profit. So minus 11 millions. That is from working 2, I think. So 36,000. Minus 10,500 minus 12,000 minus 11,000. You remain with incomes, other incomes of 2,500. Then you move to the other operating expenses. Parent, that is 171,300 plus subsidiary 115,460. But there are some adjustments to make. First of all, I'll have to add back the excess depreciation on the fair value adjustment. There was a fair value adjustment. That excess depreciation should be added back. That is 1,000. That is, in fact, it should be reduced. Yeah, we have to reduce because we said that according to our adjustment, credit the operating expenses. So go and reduce them. It's supposed to be minus, not an addition. So I'll say minus. That depreciation was how much? Was it 1,000? Yeah, it's 1,000. So we have to reduce the other operating expenses. And this is from working number 4. The assumption is that we are assuming that the depreciation is charged to the other operating expenses. But sometimes it can be cost of sales, whereby you have to adjust your cost of sales. So credit other operating expenses, 1M. Then the other adjustment to make on the other operating expenses. Do we have anything else? We have the management consultancy. Credit other operating expenses with the 12 millions. That is working 3. So minus 12 millions, that is working 3. Then I think I'll also have to reduce these other operating expenses with the extra depreciation charged against the profit of STL on the transfer of the non-current asset. That was 1.1. So 1.1. So minus. That is working 2, I think. So 171,300 plus 115,460 minus the 1,000 minus 12 and minus 1.1. My calculator shows 272. 660. 272,660. Now that gives us our operating profits. But I think before the operating profits, they first remove the finance costs. Okay, can say less the finance costs. The other item is finance cost. The parent is 56,100 plus the sub 10,300. This gives us 66,400. These are finance costs, so they will be deducted. So you get what we call the operating profits. Operating profits. So 83,000 plus 2,500 minus answer minus 272,660. I get my operating profits as 486, 440, 486, 440. That is operating profits. Now from the operating profits we go to the income tax. Just add. It's just a matter of adding. For example, you get 103,590 plus the tax of the subsidiary 56,580. When you do that and you add, that is 160, 170. That is tax to be deducted. So you get your profits for the year. Profits for the year 486. You get your profits for the year as 32,670. That is your profit for the year. Then of course you have other comprehensive incomes. Other comprehensive incomes, and here we have a gain on property, plant and equipment revaluation. You add, that is 1/1/9 of the parent plus 5/40 of the subsidiary. 5/40 plus 1/1/9. This gives you 1,000. Then you get the total comprehensive income, which is 8,328 millions. That is your total comprehensive income for the group. So we have consolidated, by the way. We have been doing consolidation. We have consolidated the statement of profit and the statement of profit and loss, as you can see. However, when it comes to the statement of profit and loss for the group, we have to bring in the NCI in. We have to bring the NCI in as a one-line adjustment at the end of the statement of profit and loss and other comprehensive income. So we have to show how the profits are going to be attributed. So I'll say profits for the year attributable, profits for profits for the year attributable. So we have to show the profits for the year attributable to owners of the parent, that is DEL's shareholders. Then you also have to show the profits attributable to the non-controlling interest. Of course, I will do this in working 6. But when you add all those profits, those to the parent and then those to the NCI shareholders, they should be adding up to 326,270. Then you also have to attribute total comprehensive income for the year attributable to the owners of the parent, and then NCI. But still, that total should be 328. Okay, let me show you how you can come up with the profits attributed. This is working number 6. NCI share in profits for the year of STL. Profits for the year. So for the profits for the subsidiary, we see profits for that for the subsidiary. The subsidiary reported a profit of 82,060. Those are the profits for the subsidiary, 82,060. But now these profits have to be adjusted. We have to adjust them. First of all, we see that the subsidiary sold. The subsidiary sold goods, sold smartphones to the parent. So the subsidiary has that unrealized profit. So we have the PAP. We have the PAP. That is working one. That PAP is 9 millions. That has to be eliminated. Can take you back to the working of the PAP. Yeah, we have a 9 million. Being that the subsidiary is the seller, I have to adjust the profits for the year of the subsidiary. Then the depreciation. Excess depreciation in brackets fair value adjustment. That depreciation of 1,000, that is from working number 5, I think. No, it's working 4. That one I will just add it back because the operating expenses, we assumed that they were overstated by the extra depreciation charge. So I will just add back the 1,000. Then the buildings, the additional depreciation, extra depreciation, because this subsidiary acquired a motor vehicle from the parent. So the extra depreciation, that is non-current asset transfer from working to. There was a depreciation of how much? Depreciation of 1.1. Depreciation of 1.1. That one should be added back. So you'll get the adjusted profits as how much? 82,060 minus the 9,000 plus 1,000 plus 1.1. That gives you 75,160. So those are the profits adjusted. So the share of NCI in those profits, that is 30% times 75,160. That is 22548. So meaning that when I go back to my statement of profit and loss, the NCI share in the profits for the year, here we have 22548. So if the total profit for the year for the group is 326,270, but out of that this NCI shareholders have 22548, the balance of how much? 303,722. This will go to the owners of the parent. 303 722 goes to the owners of the parent. The total comprehensive income for the attributable to the owners of the parent, and then NCI. Remember, you always start with the NCI. So for the NCI, if I have my profit share of NCI of 22548, I will just add the NCI share in the other comprehensive income of the subsidiary, which is 30% of how much? Which is 30% of 540. So 30% of 540 plus 22548, that gives you 22,710. 22,710. But remember, the total comprehensive income for the year is 328,000 or 328 millions. So the owners of the parent, for them, they receive 305 to 290. So that is your consolidated statement of profit and loss for this question. That is the consolidated statement of profit and loss for this particular question. So that is our consolidation for today. Of course, the exams over years have shown that consolidations are very, very important in this financial reporting exam, and your revision therefore needs to cover them particularly well. You should not omit any aspects of group accounts as they come every sitting. Group accounts can be examined as part of the 40-mark question, or it can appear in section B of the question paper. Don't make a mistake to go in the exam in May when your consolidation basics are rusty. Make sure you practice through the past paper questions. Thank you for watching. I remain your tutor, Senior Hannington. In case you have questions about this specific question, in case you have some other questions about consolidation, please feel free, share them in the comment section. I will answer them. Thank you. Bye-bye for now. Don't forget to subscribe, or don't forget to subscribe to my YouTube channel. Don't forget to share with friends, like, comment, etc. Bye-bye.